All right, let's talk about the absolute fundamentals of trading. If you've ever looked at the stock market and just felt a little overwhelmed, don't worry. You're in the right spot. We're going to break it all down nice and simple.
So, you see the headlines, right? You hear these wild stories about people making and sometimes losing a ton of money. But what's really going on? How do people actually make a profit from buying and selling this stuff? Well, today, that's the big question we're going to answer.
So let's start with the most basic question of all. What is trading, really? It's a word that gets thrown around all the time, but what does it actually mean? At its core, trading is really about one thing: making money from price changes. You buy something, a stock, some crypto, whatever, because you think its price is going to go up. The whole goal is to sell it later for more than you paid. It's a very active way of engaging with the markets. Let's make this super practical. Imagine you buy 10 shares of a company, and they cost 100 rupees each, so you spent 1,000 rupees. Now, let's say the price climbs to 120 per share. If you sell all 10 shares then, you get 1,200 rupees back. That 200 rupee difference, that's your profit. That's the basic engine of a good trade. Okay, but here's the thing. Not everyone does it the same way. One of the biggest differences between traders is simply how long they hold on to what they buy. Let's take a look at what that means.
You can kind of think of these as different speeds. Day traders, they're the sprinters. They buy and sell within the same day, sometimes in just minutes or hours. Then you've got swing traders. They're holding on for a bit longer, maybe a few days, maybe a few weeks, trying to catch a bigger price swing. And then there are long-term investors. They're playing the long game, holding for months or even years because they believe in the company's future.
Now, like any profession, trading has its own language, its own lingo. If you want to follow what's going on, you got to know a few key terms. So let's go over the big ones you'll hear all the time. First up, a stock, which is also called a share. This is so important. It's not just a number on your screen. It represents a tiny, tiny piece of ownership in a real company. When you buy a share, you literally own a slice of that business. Okay, every single transaction has two sides. The bid is the highest price any buyer out there is willing to pay for a stock right now. The ask is the lowest price any seller is willing to accept. A trade only happens when a buyer and seller agree on a price, when the bid and ask meet. So when you go to actually buy or sell, you have choices. A market order is basically you saying, I want it now. Get me the best price available this second. It's all about speed. A limit order, on the other hand, is more specific. It's like saying, hey, I only want to buy this stock if the price drops to 95 rupees or less. Here, you're prioritizing the price you get over how fast the trade happens. You're going to hear these two words all the time. Being bullish means you think prices are going to go up, charging ahead like a bull with its horns up. Being bearish means you think prices are about to fall, like a bear swiping down with its claws. It's just a quick way to talk about whether you're optimistic or pessimistic about the market. Okay. So we know what trading is, we know the different styles, and we've learned some of the lingo. But this all brings us to the biggest question, the most important piece of the puzzle. Why do prices move at all? What's the engine that drives this whole thing? You might think it's all about super complex algorithms and secret analyst reports. But honestly, at its heart, every single price move you will ever see in any market in the world comes down to one simple, powerful idea. Supply and demand. That's it. That's the whole game. These two forces are constantly pushing and pulling against each other, and that's what sets the price for literally everything.
It's really simple when you think about it. When more people want to buy something than want to sell it, you have high demand, right? Lots of buyers are all competing for a limited number of shares, so they have to bid the price up to get them. The price goes up. And of course, the opposite is true. If way more people are trying to sell than there are people willing to buy, you've got high supply. All those sellers are competing for just a few buyers, so they have to lower their asking price to make a sale. And so the overall price goes down. So here's how that looks in the real world. A stock is trading at 100 rupees. Then some great news comes out about the company, and suddenly everybody wants to own it. This huge surge in demand, all these buyers rushing in, pushes the price up to, say, 110. If you were smart and bought it at 100, you can now sell it to all those eager new buyers and pocket that 10 rupee profit per share. That is supply and demand in action. So there you have it. We've gone from the basic definition of trading all the way to the core force that moves every single market. Let's just quickly pull all the key ideas together. So here's what I want you to remember. 1.
Trading is just buying and selling to profit from price changes. 2. How long you hold an asset defines your trading style. 3. You've got to know the basic lingo, like bid, ask, bull, and bear. And finally, the most important one. Every single price change is just a story about the battle between supply and demand. So now you have the building blocks. You get what trading is, you know why prices move. But this leads to the real million-dollar question, doesn't it? How do traders try to guess which side, supply or demand, is about to win? How do they decide when it's the right time to buy or sell? Well, that is the perfect setup for our next explainer. We're going to dive into the different strategies and tools that traders use to analyze the market and try to make those critical decisions. You won't want to miss it. We'll see you then.